All right, let's talk about the share market. I know. It sounds super complicated, right? But what if I told you the basic idea is actually really simple? We're going to break it all down today. Let's dive in.
I mean, have you ever really stopped to think about it? You see stocks going up and down on TV, you hear people talking about their portfolios, but what are you actually buying? Is it just a blip on an app? Nope, it's way cooler than that.
So, to get our heads around this huge global market, let's start super small with just one single share. What is it? Believe it or not, that's the whole secret. A share is just a tiny, tiny slice of a company. When you buy one, you become a part owner. So yeah, if the company does well and makes a ton of profit, you get your piece of the pie. But, and this is a big but, if things go south and the company loses money, well, you're in on that too. It's the ultimate we're in this together deal, for better or for worse. Okay, let's make this even simpler. Picture this. You've got this amazing idea for a startup, right? You've got 10,000 rupees saved up, but you need more to really get it off the ground. So you go to a friend, they love the idea, and they put in another 10,000. Now you're partners, 50-50. What you just did, you just sold them a 50% share in your company. And here's the kicker. The entire giant global stock market, it's that exact same idea, just on a mind-boggling scale. Instead of one friend, a huge company is asking millions of us, the public, to chip in and buy a tiny piece of the action. So where did this whole idea even come from? Well, you have to go back about 400 years. And trust me, the origin story is wild. It involves long-shot sea voyages, treasure, and a whole lot of risk. Okay, so picture the 1600s. The Dutch East India Company wants to send ships on these epic, super dangerous journeys across the world. The problem? These voyages were insanely expensive. No single rich person could afford to fund one. So they had this genius, game-changing idea. What if we asked everyone to chip in? Regular people could buy a small piece of a voyage. If the ship comes back loaded with spices and treasure, everyone gets a cut. And right there, on the docks, the first stock market was born out of pure necessity. But let's be real about the risk here. It was absolutely huge. More than half of these ships just never came back, sunk by storms, attacked by pirates, gone. This was the definition of high stakes. And that massive risk led to another aha moment. That is, maybe the most important rule in investing today. People figured out pretty quickly, hey, maybe I shouldn't put all my money on one ship. Instead, they started buying tiny shares in 5 or 6 different ships. That way, even if most of them sank, they just needed one to come back to make a profit. And boom, the idea of diversification was born. Okay, so that's the cool origin story. Now let's fast forward 400 years. How does all this actually work today? Well, the modern market is actually 2 markets rolled into one. First, you've got the primary market. This is where a company sells its shares for the very first time. It's called an IPO, an initial public offering. The company itself gets the money. But after that day, everything moves to the secondary market. And that's where you and I hang out. We're not buying from the company anymore. We're buying and selling those shares from each other. And here, the price is all about good old supply and demand. Yeah, you're going to hear a lot of jargon, but don't let it scare you. The basics are pretty straightforward. The stock exchange, that's just the official marketplace, like the Bombay Stock Exchange. We just talked about IPOs. That's when a company first goes public. And when you hear about the Sensex or NIFTY, those are just like a report card for the market, showing how the top companies are doing on average. Oh, and one more thing. Founders, like Mark Zuckerberg with Facebook, often hold on to more than 50% of the shares. Why? So they can keep control and make the big decisions. But think about it. Unlike those guys on the docks back in the 1600s, a company today can't just show up and start selling shares. The process now is super long, super complicated. So what gives? Why all the red tape? One simple reason: to protect us, the investors. Because let's face it, history is full of scams. People starting fake companies, taking everyone's money, and just disappearing. After some massive scandals here in India, like the Harshad Mehta and Satyam scams, the government stepped in. They created regulators like SEBI to act as a watchdog. Their job is to make sure a company is legit before it can ask you for your hard-earned money. All right, so now that we know there are protections in place, how do you actually get started? What do you need to jump into the market? The good news is you don't have to go shout on a trading floor anymore. It's all online. You basically need 3 things. First, a bank account. Obvious, right? That's where the money is. Second, a trading account. That's what lets you actually place the buy and sell orders. And third, a demat account. Think of this as a digital wallet that holds your shares. And honestly, it's gotten so easy now. Most banks will offer you a 3-in-1 account that just bundles them all together. Now, you can't just call up the stock exchange yourself. You need a middleman. That middleman is called a broker. This could be your bank, or more likely these days, a trading app on your phone. They're the ones who actually make the trade happen for you. And for that service, they take a tiny little fee, which is called the brokerage.
Okay, before we wrap up, we need to talk about something really, really important. The fine line between investing and just plain gambling.
People ask this all the time. Isn't the stock market just a big casino? And the honest answer is, well, it can be. It all comes down to how you approach it. It turns into gambling the moment you stop thinking and start, well, guessing. When you invest in a company you know nothing about, that's a gamble. When you ignore how much money they're actually making, gamble. When you buy something just because you heard a hot tip from a friend, yep, that's gambling. And trying to jump in and out of the market every single day, that's probably the biggest gamble of all. Let's go back to those ships one last time. This is where it all clicks. The smartest investors back then didn't bet it all on one ship, hoping for a massive payday. No, they put a little bit of money on the whole fleet. And that right there, that's the core of smart investing. This is exactly why you'll hear so many experts tell beginners to start with something called a mutual fund. Think of a mutual fund as buying a share in a pre-built fleet. With one click, you're invested in dozens or even hundreds of different companies, and a professional is managing it all for you. It's the easiest way to not put all your eggs or treasure in one basket. So at the end of the day, the share market isn't about getting rich quick. It's not a casino. It's about owning a piece of the future. It's a way to invest in the companies and ideas that you think are going to shape the world. So the real question isn't just about making money. It's what piece of the future do you want to own? Thanks so much for tuning in.